what is duration and why should I pay attention to it? Guys?
You want to start out, Matthew? You want me to take it now?
No, you can
I
jump
tell
on
you
in there.
what,
I'll chime in.
most people, I mean, duration from an academic point of view is well. Let's go a little further back. Bond prices typically move in the opposite direction of yields. So when the yields of a bond goes up, that means the price is going down.
Right.
And it takes into account the present value of all
Yes.
of the expected future cash flows and
I
interest
think
payments.
you have to take into account. Let's say, for example, you own a bond that is due, quote, matures in 15 years.
Mm-hmm.
The duration will always be less
Yep.
than the maturity because you have to take into account you're going to receive interest payments every 6 months over the next 15 years. So the average duration is going to be less than that. And that's the true measure of when you, as you pointed out, in just layman's terms,
Right.
when I'm the net present value of all the money I'm going to get back is I'm going to get it back in X number of years.
Yep.
Right. So, go ahead.
No, you go ahead.
Well, so to the question, so why should I care? The longer the duration, the more
Interest
sensitivity.
interest rate sensitivity.
That's right.
And that's the definition that most people should worry
Yeah.
about because it's volatility.
Yeah. So if the Fed chooses to raise interest rates 1%, that's going to adversely impact a fixed income instrument with a long
Maturity,
duration.
and it won't do much for something that's due in 90 days.
Right.
Okay? So really, when it's useful for individuals is that when you look at bond funds, okay, and you may have a bond fund that says it's a long-term bond fund, if you do go to Morningstar and look up the bond fund, it'll give you the duration. So it might say, someone might call themselves a midterm bond fund. And you go take a look at it, and it's got a duration of 9 years, and there's another fund that has a duration of 5 years. Where you're going to be much riskier in a 9-year duration than you are in a 5-year.
Yeah. And when looking at volatility, typically, rule of thumb, you can multiply the change in interest rates by the number of years to maturity of the bond. So if interest rates go up 1% and you have 5 years to maturity, that bond should fall or increase by 5%.
Right.
So it's a measure of volatility as well.
Yeah.
There you go.